Hello all of you. I hope you all are doing good. Today we are going to revise accounting standard 11, that is the effect of changes in foreign exchange rate. As you can see that here what we are going to cover in this chapter, that is first definition, foreign exchange transaction, foreign operation, foreign loan. The purpose of loan might be short-term loan, long-term loan. Other than PP, then long-term loan. For PP, change in classification of a foreign operation, integral to non-integral or from non-integral to integral. Forward contract, meaning of forward contract, then accounting of forward contract. In accounting of forward contract, two possibilities: when forward contract is for hedging or non-speculative purpose, or when forward contract is for what? Trading. Now first we will discuss why there is need of this accounting standard 11. As you can see that from the name, that the effect of changes in foreign exchange rate. We know that here the daily the foreign exchange rate fluctuate. First of all, what is this foreign exchange? For example, that for $1 how much we have to pay? Okay, suppose 85 rupees that here. So that is the foreign exchange. For one currency, how much we are paying that? Okay? The ratio of the two currencies here. Okay. Now what is going to happen that when we do accounting that here, it might be happen that we have purchased something in foreign from foreign and we are going to pay them in the foreign currency. But in India, suppose when we are preparing our financial statement in rupees, I cannot record it in dollars or any other foreign currency. I have to record it in rupees only. So, which exchange rate should I use? And exchange rate daily fluctuate that here. So, this accounting standard 11 guide is that here. Which exchange rate should we use in different scenario, different accounting treatment, all those we are going to discuss here. So, let's start that first with the definition. But before I come to definition, basically from accounting point of view, I divided this accounting standard 11 into 4 parts that here. As you can see that here in scope, that first is foreign currency transaction, then foreign operation, foreign loan and forward contract. Basically this foreign loan and forward contract is a part of foreign currency transaction only, but I keep it separately because their accounting treatment is quite different that way. Okay, so let's start first with definition, then I will come to the accounting treatment of all these four. Don't worry, very simple. Okay, now let's start with first definitions that here. Okay, no need to mug up anything, just understand that here. What do you mean by exchange rate? Exchange rate means that here now when ratio of exchanging two currency. For example, that for $1 how much we have to pay? For example, the exchange rate 85 rupees. So for $1 we have to pay 85 rupees that here. That is the ratio of exchanging the two currencies that here. Now, what is this foreign currency? Any currency, this currency other than the reporting currency. Means any currency other than the reporting currency. So what do you mean by reporting currency? For us, the reporting currency is the Indian rupees. Reporting currency means the currency in which we are preparing our financial statement. We are reporting that here, okay? So for us, that Indian rupees is the reporting currency. All other currency means for us the foreign currency. Okay. What is exchange average rate? We know that here. Daily the exchange rate fluctuate that here. So average of those, we call them the average rate. Okay. So meaning mean of exchange rate during the period. Spot rate means the rate, exchange rate on the date of transaction. Suppose I purchase on, let's say, 15th of March. So what is then we'll discuss about the accounting, but the rate on the date of transaction, what we call them? We call it spot rate. What is this closing rate? Closing rate means exchange rate at the balance sheet or at the end of the year, or you can say the balance sheet date. Okay. So closing rate means the rate on the balance sheet date. And one more thing, opening rate means the rate at the starting of the year. Okay. Now, two things you have to understand, that two terms, monetary and the non-monetary. Okay, because there are, when we discuss about the accounting treatment, there's some different treatment for monetary and non-monetary items. Okay, so you have to know what to mean by, no need to, to mug up those things, just understand that what to mean by monetary item. They say money held. They say money held. Money held, can I say that here? Cash in hand is money held. Okay, so money held and asset and liabilities to be received or paid in fixed or determinable amount of money like debtors, creditors, loan, cash, bank, etc. So what they're saying that here now, any asset or liability which is to be received or paid in fixed or determinable amount. It means we know that how much amount is receivable, how much I'm liable to pay. For example, we know that here debtors, how much is receivable from him, how much I'm liable to pay to creditors that here. Okay, how much loan we have to, how much I'm liable to the loan, I'm liable to repay the loan that here. Okay, so these are the monetary items. To make it simple, if you go to the basics of accounting, all the personal account, not generally I'm saying, not generally all personal account are the monetary item and cash is a real account. but cash is also a monetary item. So cash, money held, or anything which is receivable or payable, and I know that. The fixed amount or determinable, I know that how much is receivable, how much is payable. Like the debtors, creditors, loan taker, all these are monetary items. Non-monetary item means, your 7th point here, is asset and liability other than monetary. So anything which is not monetary will be considered as what? A non-monetary. You got the point here? Okay. Now it says that here now, foreign operation that here. Foreign operation means that here now, we have a certain business there. Okay, for example, the branch, okay, so you can say subsidiary, associate, joint venture or branch with activities based in the foreign countries. So I have some for example, we are in India. Okay, now we have a branch in Dubai or we have a branch in New York. Okay, outside the India, that is say the foreign operation that here. We have certain business, okay, in foreign, we call them foreign operation. What not? There are two types of foreign operation, integral and non-integral. Now, integral means that it is just an expansion that, or they are basically part of my, for example, we have a office in Chennai. Okay. Now we have a branch in Dubai. Okay. Is it integral or non-integral? Depends that here. If that, the branch that we have in Dubai, that depends on us only. We are going to send the goods to them. If they need a fund, we will give them. Okay. We call it integral. And they will mention in your question. Don't worry. So they conduct activities as a part of the reporting enterprise. Reporting means we are in India. We are in Chennai, suppose that here. So we are the reporting enterprise, and we have a branch in Dubai which depends on us only. We send them goods that here, they sell in the local market there. Okay, so that is integral. Non-integral means operate independently from the reporting enterprise. So they operate independently. It means suppose we are in Chennai, we have a branch in Dubai, but in these cases, I'm giving an example that they work independently. They don't depend on us. They purchase the goods in the local market there. Okay, if they need fund, they borrow the fund there only. So they are not dependent on us. That's a non-integral. Okay. So these are the definitions. No need to learn that. Just understand this. Now, what I will do that here, we are going to start from the foreign currency transaction. That first of all, understand that here, I will discuss with you what to mean by foreign currency transaction, and then we'll see the accounting treatment. Very simple. Just you have to listen me. Everything is written in rapid gist here. Okay. Now, when I say that here, now what do you mean by first of all foreign currency transaction? That when I talk about the foreign currency transaction means that we have done certain transaction. I'm not saying that I have a business in foreign. I am saying that here we have done certain transaction in which we are going to do the settlement in foreign currency. For example, that here we import something from US, so we are liable to pay them in dollars that here. So that is a foreign currency transaction that, or we export something is receivable in foreign currency. We don't have a business there. We don't have a subsidiary, associate, joint venture there. I am talking about that here. I have done certain transaction in foreign currency. Okay. And then here, for example, you import goods or export the goods, okay, or you purchase some property, plant, and equipment, okay. So these are the foreign currency, the transactions here, okay. Now, this loan is also a foreign currency transaction, foreign loan, but the treatment is different, so I will keep it separately, okay. Now, what happened that now how to recognize in the books of account? There is the initial recognition. It means first time we have to record it as spot rate. Now, listen very carefully. For example, that here I purchased something, okay. We purchased something from US that here. So we pass the entry that here, purchase account debit to creditor account. What should be the exchange rate? Because I'm liable to pay them in US dollar. So let's say that here now, suppose I recorded here, for example, the purchase account debited and the creditor's account credited here. Okay. So I pass the entry spot rate. Suppose here the exchange rate here for $1 is equal to let's say the 85 rupees that here. So we recorded at this rate on the date of transaction that here. Okay. Suppose the date of transaction, let's say that here. The date of transaction suppose is 19th of November, example 2025. Example. So I recorded on these date and the spot rate because we have done the transaction. We have not yet paid the amount. If we have paid the amount, transaction has been done. Whatever the exchange, I have not yet paid the amount. Okay, it is payable. So we pass the entry purchase account debit, credit account credit by let's say 85 rupees only. But is it okay instead of recorded as spot rate? Is it possible the average exchange rate commonly used for transaction? However, they can be unreliable during significant rate fluctuation. They say yes, it is allowed to use the average rate, but if there is so much fluctuation that then this you have to use the spot rate only. Okay, spot rate means the rate on the date of transaction. Average rate means that here now is the average of that particular period that here. If there is no so much fluctuation, then it's okay to take an average rate. But there is so much fluctuation in the exchange rate, then you have to take the spot rate only. So they will give you that spot rate. If they will give average rate, take that. Okay. Now, initially we recognize that the spot rate that okay. Now what happened that now we come to balance sheet date. Now what happened that here, we have not yet paid the amount that here. We passed the entry that purchase account debit to creditor account that here. We have not yet paid them. Now on balance sheet date, I have to see that foreign currency transaction that here, whether it's a monetary item or non-monetary item. And remember that I'm talking at balance sheet date, I'm just talking about the balance sheet item that here. Monetary, we have to use the closing rate. When I pass the entry here, which entry we have passed? We pass the entry here. We debited purchase account debit and we credit to which account? Creditor account that here. So they say here now, suppose 85 only that here. Now here on balance sheet date, suppose $1 is equal to rupees 86. Okay. But I have not yet paid this amount. It is still the payable that here. So when I say this amount is still payable, it's a monetary item. We know that how much is payable that. I know that here. Okay. So what is going to happen that here on balance sheet date here now? And I know that how much I'm like. This is a monetary item. I have to use the closing rate. So what is going to happen when I going to change it from 85 to 86 that only to a creditor, not to purchase account. We are talking about the balance sheet items here. Okay. So what is going to happen? This creditor is a monetary item. So I am going to change that here now. I'm going to change that now. Creditor from 85 to 86 that here. So what is going to happen? It's because it's a monetary item. So what is going to difference is going to come obviously because I am changing that here now because we follow double entry system that here. So question might come in your mind, sir. You are crediting first. We credited to creditor's account. Now I am changing the creditor from 85 to 86. What does it mean that here? It means that I'm just changing the one item here. I'm not changing the purchase value that here. Okay. So what is going to have a difference is going to come. All this difference we are going to record in which where it will go. It will go to profit and the loss account. Okay. Now it might be happen at balance sheet date here. There's some other non-monetary item like the fixed asset. This is a non-monetary item. Okay. Is any amount receivable from the PP? No. Is any amount payable to PP? No. So I'm giving example that here on balance sheet in my balance sheet, some items are monetary and some are non-monetary. So when I say non-monetary, it might be happen that we recorded the item in the historical. Historical means at the original cost. So we carried it still at the historical cost that here. Okay. So transaction date will be the transaction date is going to be is the spot rate. I mean to say that here. If the item is non-monetary, what is going to happen? We will keep at the spot rate. So difference will not come here. For example, let's say if we fix asset that here now. I am not following revaluation model as per S10. I follow the cost model only. It is a cost only that here. So what is going to happen if my asset is a cost only? We are not changing the value. It is a cost only. So they say that here that recorded what? The spot rate only. Okay, spot. Whatever this rate was there at the time of purchase, keep it at the same rate. No change in that. Okay. But it happened that the non-monetary item I'm recording at what? The fair value. Let me give you an example. Okay, what is happening in case of fair value? They say use the exchange rate in which the determining these value typically at the balance sheet date, use the closing rate. Now, what does it mean? Listen carefully. It says that on balance sheet date that here, if non-monetary item you're recording at fair value, for example, that here, we purchase the shares of Tesla company which is in US that here. So when we purchase the shares of Tesla company that here now, but what is going to happen that here now? As per AS13, we have to do the cost of fair value, whichever is lower. We recorded that value. But what is going to happen? Just limit. Suppose we are reclassifying at the fair value that here. So when I'm saying that I'm reclassifying at fair value that here, so I'm going to change the value. But these investment I have done in US, so their value is in dollars. I have to convert it into rupees that here. It means it is already recorded in my books of account, but I'm changing it as per the fair value of US market that here. So what should be the exchange rate? Okay, in that case, we are going to use a closing rate. If your closing rate means the rate on the date of these balance sheet that day, because we are doing the revaluation on, we're finding out the fair value on balance sheet date. Okay, that's why the closing rate here. So in case of a foreign currency transaction that here, initially we recognize at spot rate on balance sheet date, all monetary item at closing rate, non-monetary item if we record historical cost, spot rate, and if we recorded fair value, we are going to record a closing rate. As you can see that here, initially, all the transactions we recorded at the spot rate, but later on we are changing some items to the closing rate that year because different rules we have on the balance sheet date. So obviously, now imagine a trial balance, something you recognize initially at a spot rate, and later on balance sheet date you are changing them from a spot rate initially recognized like the creditor here. Now you are changing to the closing rate. You are changing the rates that here. So what is going to imagine a trial balance, the different rates we are applying for purchase 85, for creditor initially 85, now we are changing to 86 like that. Okay, we're changing that. So my trial balance is not going to tell you that here, because different rates, if the same rate apply for all the items there in P&L account in my trial balance, so my trial balance will get tally, but different rates I'm applying for the different items there. So my trial balance is not going to tally, and that difference is going to be recorded in profit and loss account as foreign exchange gain or loss. This is accounting treatment in case of a foreign currency transaction that here. Okay. Now what happened that year? Now I'm talking about the foreign operation. What do you mean by foreign operation? Foreign operation means we have a business or we have some expansion like the subsidiary, joint venture, associate, branch in a foreign country. We call them foreign operation. There are two types of foreign operation. We call them integral foreign operation that here now, and we call them what? Non-integral foreign operation. When I say the integral foreign operation, what is going to happen that here? Same as a foreign currency transaction. No need to, I mean to say, discuss here. Why? The accounting treatment will be same what we have discussed for the foreign currency transaction. Same initial spot rate, then monetary, non-monetary closing rate. Okay, non-monetary historical spot rate, fair value closing rate difference will go to P&L. Same treatment. But when it comes to the non-integral foreign operation, what is going to happen? All income and expenses will be recorded at the spot rate. Okay, that is the transaction rate. But all my assets and liability is going to be recorded at closing rate. There is no bifurcation of monetary and non-monetary here. Okay, in case of a non-integral, all the assets, all the liabilities is going to be recorded at which exchange rate? The closing rate. Okay, but here what happened? Difference is going to come because in my trial balance that here now, we are not using the same rate. For income and expenses, we are using spot rate, and for the asset and liability, we are using what? The closing rate. So difference is going to come. But they say here the difference we are going to record in a FCTR. What is this FCTR? We call them foreign currency translation reserve account. So you will ask me, sir, this foreign currency translation reserve, will it go to profit and loss account? No. It is not a part of profit and loss account. It will be shown under reserve and surplus as a separate item. And reserve may have a debit balance. The reason is that it is not necessary when I prepare my trial balance, when the exchange, the difference come in my trial balance that here now, we are going to record this foreign exchange gain or loss, whatever in a foreign currency translation reserve account. That might be debit balance might get short or credit balance might get short that year. That's why I'm saying this foreign currency translation reserve might have a debit balance that year. Okay, the reserve may have a debit balance. So no problem. If it is a debit balance, so can I record on asset side because asset has debit balance? No. If it has a debit balance, we will record as a negative figure. Okay, negative figure foreign currency translation reserve account. So will it always be in my reserve and surplus? Yes, it will be in your reserve and surplus with the name foreign currency translation reserve that year. But remember that here, when the net investment in such non-integral operation in full or in part is disposed of, then this reserve will be proportionately recognized in P&L account. What they are saying that here, it is going to appear in foreign currency translation reserve account only. But what is going to happen that here, can I transfer this foreign currency translation reserve to my P&L account? The answer is no. We can, but exception is that only we can transfer it to P&L account when the investment we have in the foreign operation like the subsidiary, joint venture, whatever. When we dispose of those investment, in that case only, or we partially dispose of the investment that year, in that case only that year, that amount from the foreign currency translation reserve we can transfer to profit and loss account. This is the accounting treatment that we have to do when we talk about the foreign operation. So we discuss about the foreign currency transaction. What is transaction? We are purchasing, selling something in foreign currency. Okay, here foreign operation, we have some business in foreign that year. Okay, now I'm coming to a part of foreign loan. Very simple, just listen that here. So when I talk about the foreign loan, what is the intention that you have to loan? It might purpose. So that might be for example, let's say the A point here. Okay, that might be the short-term loan. Short-term loan means for a short period of time. Then might be the long-term loan. Okay, long-term loan that might be taken for business. So you can say that here. Taken for business, you can say that here now. Let me say B and C here. Taken for business needs, you can say here other than. Okay, other than PPE that here. PP is property, plant, equipment. Or you have taken loan for the purpose of property, plant and equipment. Let's discuss one by one each of them. Very simple that here. Okay. So what is going to happen that here now? The first point, I take a short-term loan. So we are talking the loan, foreign loan. So initially we are going to recognize at what? Spot rate. You took a loan. Let's see example that here. For example, if I say that here now, $1, okay, the $1 is equal to rupees 80 that here. Okay. So $1 is equal to rupees 80 means we are supposed to take a short-term loan of $1,000 from foreign bank. So $1,000 multiplied by rupees 80, that is going to come how much? 80,000. So I will record entry, bank account will be debited and loan account will be credited. Okay. Initially, and balance sheet, they say we have to record that we are talking of loan. Why? Because loan is a monetary item. Okay. We know how much you're liable to pay. So we have to use on balance sheet date the closing rate only. Okay. Now two situation. On balance sheet date. Okay. Suppose on balance sheet date, on balance sheet date here, suppose the exchange rate is how much? This point to this. Okay. Suppose on balance sheet date that here now, the exchange rate is 82. Now, for $1 of loan, I'm not liable to pay 80. How much we are liable to pay? I'm liable to pay how much here? 82 that here. So, loan is a monetary item. We have to increase the value. So, you can see that here now, how much additional we have to pay for $1? Rupees 2. So, I will say that initially recognized at 80, I have to increase by 2. So, loan will be increased by rupees 2 multiplied by $1,000. That is going to 2,000. So, where this exchange loss will go? It will go to profit and loss account. Where it will go? It will go to profit and loss account. Simple that here. Okay. Exchange loss, it will go to profit and loss account. Now, suppose on balance sheet date, suppose let's change the situation. The exchange rate is 79. So, what does it mean if I say the exchange rate is 79? It means that here, when I say the exchange rate is 79, for $1, I was liable to pay 80 rupees. Okay. Now, the exchange rate is 79. For $1, I have to pay just 79. I have a gain of 1. So, decrease in liability. Initially, I was liable to pay 80. Now, I'm liable to pay 79. The decrease in liability. Decrease in liability should be debited. So, I'm going to debit here the loan account. In this situation, I'm going to debit to loan account. Okay. Either or. Okay. This situation or two different situations. Okay. Now, it's the gain. So, where this gain will go? This gain will go to profit and loss account. We know that here we credit gain in P&L or debit to P&L in case of a loss. Simple. Very simple. Okay. Now I'm coming to a point that here I took a loan long term that here that is other than they taken for the businesses, or you can say that here you can write it down that other than PP property plant and equipment. Okay. Now understand this. Initially, other than PP has a different treatment. Point number C. Okay. Now initially we are going to recognize at what? Spot rate. Let's take an example. Same. I took a $1. Suppose on $1 is equal to rupees 80. I took a loan of $1,000. So I'm going to pass $1,000 multiplied by 80. That will become 80,000. So I'm going to pass the entry. Bank account will be debited by 80,000 and loan account will be credited by the 80,000 here. Now, when I say that at balance sheet date, I'm to use what? The closing rate that here. Okay. So again, it's a monetary item. The loan is a monetary item. So that it has to be recorded closing rate. But here the difference, we have the option either to take P&L or this one other thing I will discuss with you. Okay. Now suppose your on balance sheet date, suppose the $1 is equal to rupees 82. Now initially when I took a loan, the $1 is equal to 80. I was liable to pay 80. Now I am liable to pay on balance sheet at 82. So I have a loss of 2,000. So increase in liability, I will credit to my loan account that much amount additional I am liable to pay. Okay. Increase in liability should be credited. But what normally we do, we take it to the P&L account. But here we have the option. Either we can take it to the P&L account is exchange loss of 2,000 that here, or what we can do that there is a one account FCMITD. What is FCMITD? Foreign currency monetary item translation difference account. That is FCMITD. Okay. So they say they are giving us the option that here now that instead of in case of a long-term loan taken for other than PP has a different treatment. I will come to that. So they say you can take the FCMITD account. Not 2 point is that. Where this FCMITD may have a debit balance or it may have a credit balance. What is the treatment? I will come to that. But the question should come in your mind that here, sir, why they are not, they are allowing to take it to P&L account, but why they have given us the option that here, to instead of taking it to P&L account, take it to FCMITD account. If it is a debit balance, it will appear on asset side. If credit balance, it will appear on liability side. So why they are giving us the option, instead of taking it to P&L account, record in balance sheet that. But the reason is that because I have an argument that here. The reason is that I will say that here, this exchange gain or loss, this is not my fault. This is not my fault that here. If I took a foreign loan that here, and I'm going to pay that foreign loan here, what is going to happen that here? If the exchange loss happens, not because of me, I'm not responsible for that exchange loss. It fluctuates in the market that here. Because of that fluctuation that here, the loss is appearing in my books of account and that I'm debiting to my profit and loss account. Loss is going to come there. So who is responsible for that? Suppose my company is recognized in a stock exchange. When I show my financial statement to the users of financial, what they will say that here? Well, sir, your company is going down. The profit is reducing there because we have recorded certain exchange loss in my P&L account that here. It is going to hamper my profit and loss account. So I have an argument here. There is no fault of me that because of the fluctuation of exchange rate in the market, I'm going to record in my P&L account that loss. Who is responsible for that here? So what is going to happen in that case here? They give us the option that here, instead of taking to the profit and loss account, they give us the option that here, they create FCMITD account that here now. And what should the treatment of that? For suppose here in this example, I have a loss of 2,000 rupees. These 2,000 is going to appear in my FCMITD account that here. It has a debit side. We have debited. Here we have debited this exchange loss that here. So I'm going to record that here. Will it appear like that? No. If suppose that here is the loan is for the 4 years, we have to write it off over a period of 4 years. It will go to profit and loss account over a period of 4 years. So 2,000. Suppose the loan we have taken for 4 years, so 500 each year. So see that here. So amortize over the period of loan on SLM basis in P&L. It might be favorable, unfavorable, not necessarily always for exchange loss. It might be gain that year. But we are going to slowly will take it to the P&L account, not in one time that year. You got a point here? This is the long-term loan that we have taken other than PP. But okay, let's change the situation that year. Suppose the exchange rate on balance sheet is 79 that year now. Now, initially I was liable to pay loan 80,000. Now, the exchange rate is 79. So, I am liable to pay 79,000 because we took a loan of $1,000 here. So, decrease in liability should be debited. So, I will debit by 1,000. Again, I have the option. I can take it to the P&L account or I can transfer it to FCMITD account that year. Same, it is a favorable that here. Over a period of time, whatever the life of the loan, in that proportion, I will take it to the P&L account. Got a point? This is going to be happen in case of long-term loan other than PP. But if I took a loan that here, for what purpose? For to purchase the property, plant and equipment. So initially I am to recognize same as the spot. For example, again, same figure. We suppose $1 is equal to 80 rupees. We took a loan of $1,000 at a rate of rupees 80. So I am to recognize the entry. First of all, I took a loan of bank account should be debited and loan account will be credited here. But then I purchase the PP, then PP account will be debited and bank account will be credited. I took a loan and I purchased the PP here. Okay. We took a loan to purchase the PP. So we took a loan from the foreign bank. We took a loan of 80,000 rupees and then we purchased the PP here. Okay. Now, loan is a monetary item that here. The balance sheet dates come that here now. And what happened here? In case in balance sheet dates come that here, on that date, suppose the exchange rate is not 80, is 82. Now I'm liable to pay to that loan, not 80,000, 82,000. Correct? I have a loss that here. So I have again here exchange loss, it will go to P&L account, but they have given me the option to add it to the cost of the PP. Again, the same argument I have. I will say it's exchange loss. Why should I take it to P&L account that my profit will go down? So AS11 gives us the option that here, instead of taking directly to the P&L account, they have given us the option that here. What to do that here? To add to the cost of the PP. So, and then it will come in the form of depreciation to P&L account. You got the point? These exchange loss we are going to debit to P&L account. Or suppose if I say that here, on balance sheet date, suppose the exchange rate is 79 that year. So what is going to happen when I say that the exchange rate is going to be 79? Initially I was liable to pay 80,000. Now I am liable to pay 17. I have a gain that year. So we'll say the gain, take it to P&L account. Yes, we can take it to P&L account. But they give us the option again to adjacent PP account. So here I am debiting PP, here I am crediting PP. Okay, got the point. If the debit side is a loss, it will debit will to PP. So what is going to happen that they say it's the paragraph 46. Only remember this paragraph number of AS11 that year, because if an examination if it's come, you have to give the reference there. Okay. And then they say exchange differences on long-term foreign currency material item related to depreciable asset can be added or deducted from the asset cost and depreciate over its remaining life. Okay, so we add to the cost of the PP. If it is a loss or a gain, we credit to the cost of the PP, and whatever the value comes of the PP, that is going to depreciate over the remaining useful life of the asset, and it will go in the form of depreciation to profit and loss account. This is what we have discussed about the here accounting treatment of the foreign loan that here. Now I'm coming to the next point, that is change in classification of foreign operation. What does it mean that? My foreign operation is of two types. It might be an integral, it might be non-integral. But initially, suppose it was an integral that I'm going to send the goods to them. If they need money, I will send to them. Okay, this is like the integral. But it might be happen later on that they convert it from the integral to non-integral that here. So when it's come to the integral, where do we difference record? We difference is record to P&L account. But when it's come to non-integral, where the differences will come? Difference will come to foreign currency translation reserve account. So what it says that here now, this is integral, non-integral. So I'm converting from integral to non-integral. So initially difference go to P&L. Now in non-integral, difference go to foreign currency translation and reserve, FCTR. So no problem. When you convert into a non-integral, keep it those items in where accumulate exchange difference in a foreign currency translation reserve that here. Okay. So what is going to happen now onwards that here now? the difference will be recorded in foreign currency translation reserve. But if you're shifting from non-integral to integral, so where you record in non-integral that here now? In non-integral, I record in foreign currency translation reserve. In integral, I record P&L. Now I understand, now I convert into integral, I will take the difference to P&L account. But what about the previous balance of foreign currency translation reserve? Can I transfer it to P&L account now because it is integral? The answer is no. They say it will be in FCTR only that here. Okay. You can transfer it to P&L account only when the investment that we have in foreign currency or this foreign operation, the investment we will dispose of. Only in that case we can transfer the balance of FCTR to P&L account. Okay. So therefore the exchange difference recognized upon disposal of operation. It means it will be in FCTR only, even though you convert it from non-integral to integral, and we can transfer this FCTR to P&L account only we dispose of the investment that we have in foreign operation that here. Okay. Now the last part of accounting standard 11, there is a forward contract. Now what is going to happen? First you have to understand what do you mean with the forward contract. Let's say that here now, it means the contract for purchase or sale of a foreign currency on a specified future date at an agreed foreign exchange rate. Now understand this here. Suppose I'm taking the figures that here of the same figures what we have, what is mentioned in the example. I know that they are different. Let's take a different exchange rate. Okay, no problem. Suppose if I say that here now, today I enter into contract that here. Okay, I import something that here. So I import something. Suppose this is US and this is our India. So I import something from US that here, and we are here in India. Okay. Now what happened that here now? I import something I am liable to pay. Suppose if I say today the $1 is equal to rupees 85. So I am liable to pay how much? 85. But I say I will pay them after suppose 4 months that here. But I am worried that here, suppose I purchase suppose anything is of $1,000. So today if I pay them, I am liable to pay for $1 how much? 85. But and 85. Okay. Now I am going to pay them after 4 months. So after 4 months, still I have to pay $1,000 only. But when I say I am going to pay after 4 months, still I am going to pay the $1,000. If I say that here now, $1 is equal to, I don't know what will exchange rate after 4 months. So I go to bank and I tell them I want to fix this foreign exchange. I say I will pay you for $1.86. I fix this amount. This is the forward contract. Therefore, you will say, sir, you are still at loss. I ask you why. You say, sir, today the exchange rate is 85. Now you fix the amount. You will go to bank after 4 months, and for $1 you will purchase the dollars from them, and for $1 you will pay them 86. So today if you buy, 85 is the rate. After 4 months you fix, and whatever is the rate after 4 months, I don't care. I enter into a contract today and I fix the price at what? The 86 that here. So what is going to happen that now? We know them. You say, sir, but you're 86 that here, you'll be at loss. I know I'm at loss here, but at least I know the amount. At least I know it that here. For 80, instead of 80, I'm going to pay 86. But it is not uncertain. At least I know that after 4 months, whatever the exchange rate in the market, I don't care about that here. I know that here now. I'm going to pay that here. How much that here? For $1.86, I know that I'm at loss. So this is what, first of all, this is the forward contract. The first that we have here, there are two types of forward contract into accounting treatment for the hedging or non-speculative. To make it simple, actually you purchase something. Okay. For example, if the first transaction purchase or sale of goods or PP, anything that here, and you enter into forward contract, you purchase and you enter into forward contract. What is the accounting treatment? This forward contract loss, instead of 85 to pay 86, there is a loss of 1. I have to recognize over the life of the forward contract. So you can see that now they say here, calculate exchange gain or loss here on forward contract on agreement date. So the forward contract rate minus spot rate. Spot rate means what is the rate today we have? This is spot rate. This is spot rate. And this is forward rate. So they say forward rate minus spot rate. Okay, so we have a loss here that will recognize in P&L over the life of the forward contract. So for example, that here now, and they say Mr. Ajay Bam bought a $30,000 plant on 30th of November 2025. Okay, payable in 6 months. Enter into forward contract at 62.15 per dollar. The rate on 30th of November 60.75. Now understand, we enforce on we purchase a plant on which date? 30th of November. Okay, so here the exchange rate, spot rate. Okay, spot rate here was how much is 60.75. I enter into forward contract here. Forward contract here. Okay, forward contract, and the exchange rate is how much here? Now 62.15. 62.15. So what is going to happen that now, instead of paying that is 60.75, we are going to pay them 62.1. I know I am at loss, but at least I know how much is the amount. If I say 62.15 minus 60.75, for $1, I am paying additional 1.4. 1.4 rupees I am to pay for $1 additional. Multiply by, there is how much is the amount? 30,000. So I will say that here now, multiply by 30,000. So that is going to, that is going to come how much? Rupees 42,000. Okay, 42,000. Okay, but we enter into forward contract for 6 months. It is mentioned that it is for how many months? This is for the 6 month that here. Now what is going to happen that now that we enter into contract on 30th of November, 1st of December. Year is going to end on 31st of March. 4 months will come here in this year and 2 months will come in the next year. So 4 months will come here and 2 months will come in the next period. So proportionately this 42,000, okay. So 42,000, if this loss is for 6 months, how much will be for 4 months? That will come 28. If 42,000 is for 6 months, then how much will be for the 2 months? This will come 18,000, 14,000. You got the point. This is how we do that. But the second type of forward contract is for the trading or speculation there. Basically, we are actually, to make it simple in this case, we are actually not buying here any PP and all that. Just we enter into, it's like a speculation. We enter into contract. We'll see, we decided, we will see the rate, we enter the forward rate and we'll see the actual rate on the date, whatever the date we have decided in future, and difference will be settled there. Okay, we have not, it's like a speculation only. Okay. So here we are actually not purchasing the goods here or any PP that here. Okay. So what is the, they will mention, is it for speculative or non-speculative purpose? So they say the treatment for premium or discount difference between the spot rate and the forward rate on the contract is ignored. Why ignore that here now? Because today whatever the spot rate and we enter the forward rate basically, but settlement will not have, settlement will done here. We will actually see, for let's take an example that suppose today is let's say the 1st of February. Year is going to end on any date that year. Okay, let's say that year we enter into contract that year, any day, 1st of February for let's say 1 month. 1st of March I will come that year and I will see, we 1st of February we decide whatever the spot rate, suppose $1 is equal to 85 on 1st of February. We enter into forward contract that $1 is equal to 87 suppose. So after 1 month I will come that year and I will see that here on 1st of March we fix the price $1 is equal to 87. What is the rate on that day? And the difference will settle that day. So there is no involvement of spot rate here. Okay. So we spot rate no involvement on 1st of February. Suppose I enter into a contract and that day the rate was $1 is equal to 85, but we fix the price for 1 month contract. I will come there after 1 month. I will see the price that we fix the price $1 equal to suppose 87. I will see the what is the actual rate on that day. Difference will be settlement. So that settlement will go to only P&L account. That's it. Okay. Now they say if in between that here now, if balance sheet dates come, we just have to mark to market value. But that is mean on settlement date, the calculated exchange gain or loss on forward contract settlement date. There is a forward contract sale rate and forward contract purchase rate that here. Okay. Now that difference will be recognized in on settlement immediately in profit and loss account. Okay. Now, so we are done with the accounting standard 11. Okay. So we have covered the definition, foreign currency transaction. Okay. Let me revise it quickly that here, especially those the accounting treatment that what we have discussed that here. Okay. Now understand that here. Okay, if we foreign currency transaction, initially it will be recorded as spot rate on balance sheet date, monetary item, closing rate, non-monetary item. It is valuation at historical cost, then spot rate, otherwise fair value, then the closing rate. Difference will go to profit and loss account. If it is a foreign operation, to integral and non-integral, integral the same treatment that what we have done for the foreign currency transaction. If it is non-integral, that is income and expenses will be recorded at the spot rate and asset and liability will be recorded at closing rate. But all the difference will go to foreign currency translation reserve account. FC foreign currency translation reserve account will be part of reserve and surplus. If it is a debit balance, it will be shown as a negative figure. It will be appear as a reserve and surplus only. But when we sell the investment that we have foreign operation, then we can transfer FCTR balance to profit and loss account. Then foreign loan, what is the intention? First, my intention short-term loan. Initially, I will recognize spot rate on balance sheet date. It will be recorded as the loan at the closing rate. Difference will go to profit and loss account. It may be gain or it may be loss. If it is long-term, other than the PP, initially we will record a spot rate at the balance sheet. It will be recorded at the closing rate that here now. But The difference, if we have the option that in that if we may take the to FCMITD account, and this FCMITD account balance will recognize your P&L account over the life of the loan that here now. Now here is on SLM basis. If it is long-term loan that we have taken for the PPs, so what is going to happen that is that initially we record a spot rate on the balance sheet date at the closing rate difference. We have the option to adjust in a PP account, and that will add we will add, I mean, depend gain or loss that here, and whatever the value come in that PP after that this adjustment, that value is going to be depreciated over the remaining useful life of the asset that here. Okay, simple. The classification is simple. And hedging in case of forward contract is a non-speculatively, the spot rate and the forward difference will go to P&L account over the life of the contract. But in case of these speculative that here, that we are not going to do anything, only on the settlement date. What is the difference that we have between the forward contract purchase rate and the sales rate, that will immediately be recognized in profit and loss account. Now we will come to the question on accounting standard, that is 11. The question number 31. This is goods purchased on 1st of January 2021 for 15,000 US dollar. At that date, the exchange rate was 75. So understand, this is the date of transaction. So on date of transaction, the exchange rate was $1 is equal to 75. Okay. Now they say exchange rate on 31st of March 21. That is on the balance sheet date. So on balance sheet date, $1 is equal to how much rupees? 74 that is. Then this it generally not happen that is. The exchange rate is, the Indian currency is getting strong against the dollar. It's okay. Now is 7th of July 2021. The exchange rate was how much? 73. So this is on the settlement that. Okay, or you can say the actual payment, or you can say settlement date. So $1 is equal to rupees how much? 73. So this is you're required to ascertain the gain or loss or gain to be recognized for the financial year ended 31st March 2021 and 31st March 22 as per AS 11. What is the treatment? Date of transaction that. What should be the treatment that here now? Here I'm going to record that initially that here the purchase account will be debited. What is the price that here? $15,000. So purchase account will be debited by 15,000 multiplied by this 75 that here, and creditor will be credited by, you can see that here now is the 15th. They just ask the gain or losses. Okay, so here just we have to record the purchase account will be debited here, and creditor account will be credited. 15,000 multiplied by 75, that is going to come how much here? That is coming here 11,25,000. But here what happened that now, suppose I recorded here the purchase account debited here 11,25,000 here, and I'm crediting to creditor account that here we credited by how much? 11,25,000 that here. Now I come to balance sheet date here. What happened here on balance sheet date that here? Now when the $1 is equal to rupees 74, now understand this here. Now I'm not liable to pay at the rate 75. I'm going to pay to creditor is a monetary item. I'm liable to pay them now on the balance sheet date at what rate? 74. They decrease in liability. So I will debit to creditor account will be debited here. Okay. That is how much? 15,000. I calculate 15,000 because instead of 75, I'm going to pay 74. So 15,000 multiplied by 1. Difference of 1 only. Okay. And this gain or loss will go to P&L account, foreign exchange gain. Okay. Now when I come to the actual, this is a balance sheet date position. When I come to the actual date, okay, that is the date I have done the payment that year. The exchange rate was not, sorry, 73 here. Okay, 73 that year. Okay. Now again that year, now this is exchange gain here. So what will I will do that here? I can pass a single entry also that here. I will say the creditor is appearing at 74 that year. So creditor account will be debited 15,000 multiplied by 74 to P&L account, because I am to pay at the rate 73, the gain of 1 rupee still. So to P&L account 15,000 multiplied by 1, and to cash or bank account will be credited 75,000 multiplied by 73. You got the point that here? So I'm passing the single entry here. So creditor account will be debited here and P&L credited, or here the bank account will be credited here. So yes, 15,000 multiplied by 74, 15,000 multiplied by 1, 15,000 multiplied by 73, because I'm to pay at the rate 73 only. Okay, this is how they have mentioned that here now. Okay, so you can see that here now they have a gain of 15,000. Okay, then they say on this they say P&L account will be credited again by this 15,000. Okay, done. This is how initially record spot rate, then balance sheet date by closing rate, the date of transaction, whatever the actual rate we have to pay at that rate. Okay. Now question number 32. A Limited has borrowed or 10,000 US dollar in foreign currency on 1st of April 2021 at 5% per annum annual interest and acquired a depreciable asset, the exchange rate. This is not the case of a loan. Okay, please. Loan. Borrowed. Okay, sorry. This is a case of loan only. Okay. Now, why we borrow? Depreciable asset means for PPE. But PPE is this. First of all, exchange rate here on 1st of April, $1 is equal to 48. Okay, anyways, 48 mentioned. Okay. And 31st March 22, $1 is equal to 51. Okay, no problem. They say you are required to pass the journal entries in the following cases. Under option paragraph 40A, not avail. Not avail means P&L. Okay. Para 48 is avail means adjustment will be done in PPE that here. Okay. Third, I will discuss with you later that here. Okay. So one by one that here. So if it is not avail, the difference will go to P&L account. So simple. So we purchase we borrow a loan. So bank account will be debited to foreign loan. So how much we borrowed? $10,000 and on that date the exchange rate was how much? 48. So bank account should be debited 4,80,000 and I am liable to pay loan that year 4,80,000. The balance sheet date before we do record the exchange gain or loss that here now is that here we have to pay the interest that year. So finance cost account will be debited or interest account debited. You know the financial statement, we call them finance cost. So this is interesting. 10,000 is the amount dollar. 5% the rate of interest, but we have to multiply with the exchange. Why they have multiplied by 41? Because when we borrow, rate was 48. Now when you calculate the amount of interest, you are multiplying by 51. The reason is that we have to pay the interest at the end of the year. What is the exchange rate at the end of the year? 51. That's why 51. Okay. This is the amount of interest. But what about the loan? The loan which I was liable to pay at the rate 48, not 51. So the exchange loss of 3. So 10,000 multiplied by 3. So P&L account will be debited and loan account will be credited by 30,000. So it will go to P&L account. But we have the option, if we avail the paragraph 46A, in that case, we are adjusting in PP. The same thing, but here exchange loss, we are adjusting in PP. So first we took a loan, same entry, bank account debit to foreign loan account. Interest, same calculation, interest of finance cost account debit to bank. Then this is foreign exchange loss account debit to foreign loan, the loss of 3 rupees per dollar. Okay, that is coming total 30. But this foreign exchange loss, instead of taking to P&L, we adjust in property, plant and equipment. You got the part? It's a figure. Okay, here it will come 30,000. Okay, directly you can say that now is the directly you can pass the entry here is PP account debit to loan. First you have debited here and then you have credited your foreign exchange loss. So anyways, net effect is PP account debit to loan account. Now the third one. This is the loan was taken to finance the operations of the activity and not to procure a depreciation. It is not for the depreciable asset. So what we have the option that we can transfer to FCMI TD account. Okay. So here you can see that bank account will be debited and loan account will be credited. Okay. Interest will go to P&L, interest account debit to bank. Exchange difference of 30,000. So exchange difference here we debited and we debited here the exchange difference. That is a loss of this 30,000. But where we are taking, we can take it to FCMI TD account. Okay. So instead of it is not for the purpose of PP, then we can adjust in FCMI TD account. We have the option that here. Okay. Then here, the question number 33 then. The Rao Limited that here, the purchase a plant for 1 lakh US dollar. Okay. On 1st of February 20x1, payable after the 3 months that year. The 1st of February. Suppose this 1st of February that year 20x1. Balance sheet date will come 31st March 20x1 and enter into forward contract for 3 months. So February, March, April, May. So they say 3 months that year. This is 1 month. Okay, 1st of February, sorry. 2 months will come here. February, March, and here 1 month will come. Okay, total 3 months. Now they say the contract forward rate was 49.15 and exchange rate on the date of transaction spot rate was how much? 48.85. So we have a 49.15 minus 48.85, that is coming 0.3 here. Okay. Now how much is it? Multiply by $1 lakh. So that will come 30,000. Okay. That will come how much? 30,000. Okay. But here it will come 20,000 here. Here it will come 10,000. So simple. Okay. 20,000 and the 10,000 will be recognized in the next. Simple, it is very okay. Now, why I find it speculative? Because we purchase non-speculative because we purchase a plant. Okay. Now, this is all about accounting standard 11 that here now. Now, if anything you want to say, you can comment here in comment section that here. Okay. So this is all about accounting standard 11 that here. Now, next accounting standard I'm going to record, that is accounting standard 12. That is for today. Take care all of you. Bye-bye.